Oh, thank you very much, Brian. We're really excited about this transaction with China. And you're right, it's been a long journey. At the end of the day, we compete in a commodity market space, and by definition, risk-adjusted cost and price are what the customers are looking for. And so we've relentlessly focused on delivering the lowest possible delivered clean LNG possible to the market. And at the end of the day, that's what our good friends and now customers at Sinopec in China were looking for. And so
can you give us an idea for
Go ahead.
Sorry to interrupt, Mike. For our audience that's maybe not, you guys speak in millions and BTUs and some unique terms in the natural gas and LNG markets. Can you give our audience, for those sort of relatively uninitiated, an idea of just the size and the scope of this deal?
Sure. No, absolutely. It overall, over the term of the contract, is going to aggregate more than 80 million tons. On a dollar basis, that'll eventually end up being over $30 billion for the life of the contract. It is 4 million tons, and you're right. In our industry, we talk about kind of capacity of contracts generally in terms of 1 million tons per annum. And so this is a 4 million ton per annum contract for our Plaquemines LNG facility, which is our second one. And on a shorter term basis, it's approximately 2 million tons out of our almost complete facility, Calcasieu Pass. But in terms of scale, it's going to end up being north of approximately $30 billion.
Wow. And I know that pricing tends to be a very closely kept secret amongst you and some of your competitors. You've got a different model. You've tried to be a lower cost because you built it in a different way. You kind of started from a unique perspective, and that was your goal. Can you give us an idea, given their demand for energy, particularly LNG, how aggressive or maybe not aggressive Sinopec and China were in negotiating this deal?
Sure. No, you're correct. We ended up taking a very different approach to configuration of our facilities. For a traditional, in our case, 10 million ton scale facility. Typically today, people will build 2 5 million ton per annum trains. We have 18 liquefaction trains for our 10 million ton facilities. And that allowed us to build them in a factory setting and take advantage of traditional Henry Ford style manufacturing in factories. We think overall, from the traditional approach relative to U.S. producers traditionally, we've probably shaved 30% off the cost. And relative to some of the international projects, more than 50%. And in commodity markets, as you know, people will compete aggressively over 1 or 2% differences in prices. And so we've been very disciplined over the years in trying to deliver value for customers and for shareholders, hopefully selling more market share and delivering great returns for our shareholders that way.
And I understand often in industries like yours, there's a competition, obviously. There's Tellurian, there is Cheniere, Freeport, LNG as well down the road. But some people say the pie is big enough for these American companies to all succeed. Is this kind of a sign, given what's going on in Europe with their sort of reliance on Russia, the UK, China, is this kind of a U.S. LNG to the rescue? And is the pie big enough for all the major LNG players in the United States to survive and thrive?
Yeah, the market, as we were chatting about earlier, is growing. There's a growing global middle class that has the same demands that the developing world has experienced with air conditioning and dishwashers and lights and water pumps, whatever the traditional demands are in the developing developed world. The developing world is going down the exact same path. So demand is going to continue to grow, and we think actually increase with more and more policy initiatives supporting renewable energies. You need to have baseload energy production to cycle around that, and gas is by far the best approach to that.